Matt Thompson and his brother Mike have been using VIX products since '07 and since October 2011 have traded a strategy using solely VIX ETPs, that being ETFs and ETNs. They offer this strategy at their group Kaizen under the name Alpha Seeker. Kaizen Advisory is located in Wheaton, Illinois, and manages about $250 million across three mutual funds, and also has managed account strategies, of which Alpha Seeker is their flagship. And Alpha Seeker is a managed account strategy that trades VIX products. I found Matt on Twitter. He is a incredibly intelligent and spot on. He's got great comedic timing on Twitter. He's a legend on Twitter, I would say, at this point. He always has great ways to graphically illustrate his points, and he always makes great points. So I took the time to look him up and get him on here. So stay tuned right now for a conversation with Matt Thompson. Welcome, Matt. So you don't actually look like Christian Bale.
Yeah, that's just my Twitter persona.
That's hilarious. I have Benny Hill persona on StockTwits, so
Nice.
I feel you. Listen, I really appreciate you coming on. I love the way you spice up our little community on Twitter
Oh, thanks.
of VIX guys. You always have some great charts and great way of looking at things. So it's really exciting to have you on. Kind of a crazy start to the year, huh?
Yeah, I mean more of the same, I guess, after last year. You're seeing vol levels I thought we'd never see.
Yeah, it's amazing that things have stayed so low. Let's see. I just lost the sound for a sec. Can you hear me still?
Yeah.
Okay. Um, yeah. So I saw you brought some charts with you. Did you want to talk about those a little bit?
Yeah, sure. I mean, I focus mostly on the VIX ETFs and ETNs. And it's kind of just a fascination of mine to see the kind of the tail risk of these things, especially obviously the short ones. So XIV would be the one that I kind of focused on with some of these slides. But yeah, so obviously XIV has done outstanding in the last couple years as VIX has been decimated and has stayed low. Not too many bumps in the road. And I've got a chart here just showing over the last 2 years XIV that note has returned 128% annually with a 2.5 Sharpe ratio, which is I mean that would beat most hedge funds out there.
Yeah, that's
And you can go
amazing.
out and buy this in your Schwab account, yeah, for I mean 135 basis point management fee. So it's pretty amazing in the last couple of years how it's done, and I think obviously that always attracts people to the space. They're looking for a return like this. I think also what it's done is sort of desensitize people potentially to some of the risks involved. And so if you actually, so we can recreate what XIV would have done going back to when VIX futures listed, which is March '04. And if you pull up the same history for XIV, that index going back, so the note listed in I think in 2010. So the index you can create back to 2004, and it kind of gives you a fuller picture of what you're in for with XIV and kind of how aberrant the this last couple of years has been return wise. So overall, since '04, that index has annualized about 38%, and the Sharpe ratio is more like a 0.7. and you've had 70 to 90% drawdowns in that index. So obviously the last couple of years kind of stands out. It's kind of a bit of a tail event on the good side for XIV. So
can you explain what this Sharpe ratio means for people?
Sure. Yeah. So the way I'm using it, it's basically just the annualized return for any data series divided by the annualized volatility. So it's trying to get at risk reward type measure, and generally it's compared to the return portion is compared to the risk free rate, which in today's market it's effectively zero. It's starting to creep up a little now, but I've used zero for the risk free rate. So some of the purists out there may may have a little bit different number, but
so we'd like ideally to have a higher Sharpe ratio for our investments. Is that true?
yeah, higher Sharpe ratio just means you get paid more for each unit of risk, and so the really good hedge funds might be 2+ or 3. Very very high performing managers 2 or 3, and we're that's a little quaint in the environment where the S&P is running at a 4 or 5 Sharpe ratio in the last couple of years, and I just showed you XIV, the short vol is running at 3 type of Sharpe ratio. So just some extraordinary numbers here. The main risk, XIV clearly is going to do well in this kind of environment while it lasts. We own it, we've owned it, continue to own it. The main, I think, tail risk that is potentially underappreciated is what XIV calls, or the issuer for XIV calls, acceleration. And that's a fancy word for go to zero, redeem the note. And so basically in the prospectus for XIV, it says that the note will be redeemed, will basically stop trading if the index loses 80% in a day. And so the index is made up of 2 different VIX futures that are set to maintain a 30-day maturity all the time. So it's the front 2 futures in some combination every day. So basically that index needs to decline by 80% in a day. And to get that done, in rough terms, you would need about a 200% VIX spike in a day. So that you can think of it in those terms. So a 200% VIX index move in a day is probably going to tap out that note. So if you hold XIV, VIX pops 200%, and you're talking, and I'll show you some data here in a second, but you're talking a big tail event. You're talking an 87 type crash. That would be enough to see your investment in XIV go to zero that day effectively.
Well, we've talked about this a little bit with some of our other guests as far as how you could get to that spot. And it also, if you're somebody who's looking at maybe buying XIV as opposed to like a leveraged S&P sort of index fund or something, it is a little bit scary because you think you're buying like $100 plus security, and it could go to zero in one day if the right conditions present themselves. So that's definitely a scary thing for people, even though it's got great returns. It's a scary thing for people thinking about putting their money into this. So it's good that you explained it a little bit.
Yeah, and it's not so much to scare as it is just it's something that you need to incorporate into your thinking if you're going to be owning these products. You have to be aware of that risk and just size them appropriately, or trade it appropriately. And so there is, the other side of that coin is XIV is the inverse VIX ETF. It can only go to zero, which is not a great outcome, but there are some out there that short, UVIXY or VXX, some of the long ETFs, and now you've got the scenario where you could actually lose more than 100%. So at least, some people look at it like XIV has sort of an embedded stop loss for you at zero. So
that's a great point. That's a great point.
Yeah.
Because a lot of my viewers sell calls in UVXY, and you do run into the situation where you could blow out and end up owing your clearing firm money in the end. And with something, at least you're stopped at zero. So that's a great point.
Right. So that is the risk that's out there, especially if usually people on Twitter talk about you shouldn't talk about percent moves in the VIX, and I understand the idea because the VIX itself is already a percentage, but in this case, in ETFs, XIV cues off of the percent moves. So a 200% move is what you're looking for the knockout provision in XIV, and it's just a simple mathematical fact that if VIX is 9, a 200% move gets you to about 27. That's not unthinkable. It's certainly, we've seen 27 plus over the years, not in one day from 9, but those percent moves do matter for the ETFs.
Well, it's definitely it's confusing for some people because these things have split so many times that you see it coming from like 200,000 or something, and you think,
right.
If you just looked at the chart as somebody who just looks at normal technical analysis, you could say, well, maybe it'll go back to 200,000 if the right conditions, but that's obviously not going to happen because of the way it's based on futures and based on the fact that it's split several times. So
yeah, it's the compounding in the instrument. It's done so the long VIX ones are down 100% since they've started roughly, and that's just a fact of it's the compounding of a bad trade for years and years and years. Now the original capital that was in the instrument is eroded, effectively all of it. So it's never going to get back to any particular price. It's never going to get back to those original prices. There's just nothing that's going to get it there. So they're all trading instruments. They're not buy and hold instruments. And the percent moves really is, at the end of the day, is what everyone's looking for on these short time frames to make money in these instruments, long or short. And so I put together a little chart saying, okay, so if we know 200% is roughly our benchmark for XIV to accelerate, let's just look back at the longest data set that we can find and see what moves in the VIX index, or its predecessor, actually, VXO, which moves would have qualified for XIV getting potentially tapped out. And so I've got a chart here that shows the largest one-day gains in the VXO index, and we just have more data for that. It starts in 1986. So you can see I've plotted VXO's one-day return in percent versus the level where it started the previous day. And I did that because a lot of people use the VIX term structure, so contango or backwardation in the VIX futures, the shape of that term structure. They use that as the stop between going long or short, or as the benchmark. VX, in rough terms, the curve is usually in a contango formation when the VIX is under 20, and it's usually back over 20, just because that's a long-term average. So we don't have VIX futures information going all the way back to 1986, so you can proxy your contango backwardation by just over and under 20 starting level. And so I've got the starting VXO level there and the VXO one-day returns, and the biggest one by far is Black Monday '87. You saw a 313% move one day in the VXO index, and
wow.
So that would definitely be enough to tap out XIV. And almost, if you look at even just the overnight gap, almost would have been enough. I think the overnight gap was 100-something%.
Wow.
So you were pretty close if you owned XIV back in '87 and you woke up that morning, you were pretty close to being done the morning of that crash. But really, that's the only one that breaches that 200% barrier in one day. There's been the whole handful that have started from below 20, so an environment where most people would likely be getting signaled to be short volatility or owning XIV. A lot of those have started. We've had 70% moves, 60% moves in the VIX index or VXO, starting under 20. So those are real. I've got on the chart I call those XIV killers. That would be ones where you're going to potentially have a big hit with XIV. You're probably not going to get tapped out, but those would be the ones that kind of keep vol traders up at night.
So you were saying that it would take maybe like an 80% move on this chart to tap it out, somewhere around there, or what?
So on this chart, yeah. So this is referencing the VXO index, so the spot VIX, and you would need to see 200% plus on this chart, to tap it out. So because then the futures don't react 1-to-1 with the VXO index or the VIX index. They're going to react something less, and hopefully that relationship, 200% move gets you about 80% down in the futures.
So it would be an 80% move in the futures, then it would tap you out. Okay.
Right. And so just incidentally, the biggest move I've seen in my actual trading career since, we've been staring at this market since '06, '07 period, the closest I've seen XIV to getting tapped out, or that 80% move to happening, was the night of Brexit. That vote there, it caught a lot of people off sides, and I think the front month future was up like 65% at one point that night. So pretty close on just a political surprise like that.
Now that's amazing, because I think that's a great example, because it's something that you wouldn't think would be, an event that would perpetuate, a huge move in volatility in the market. That's it. Would you consider that like sort of a black swan event? I mean,
Yeah, and I think of it in terms of, I think why that move is so big. It's not necessarily the seriousness of the event. It's more about how offsides did you catch people positioning wise. And you can see, I remember going into the close the day before, or the night of the Brexit vote, volatility had already started to sell off pretty good. You could see people positioning for what usually happens after an event like that when volatility comes in. You can see people starting to come into that trade and trying to jump the gun a little bit. And obviously that was the exact wrong move, and that's why you saw such a big retrace and catch up. And so it doesn't necessarily have to be, a city getting nuked or something horrible like that. It could be just the fact that the market has tilted so hard to one side and then gets surprised.
well, that's great information, because a lot of us traders in the VIX, we see a spike and people generally tend to lean into it, and that works a lot of times, but in Brexit case, definitely it would really backfire on you. I know we had a period in August of this year where, like, one day it started to come in a lot, and then at lunch it spiked again and made new highs in the volatility move, which was really scary for me. That was my first really scary situation. One thing I found that was interesting for me is that 2011 period, where volatility was elevated for a long period of time. I think it was something like 176 days of elevation.
Yeah.
Um, it's interesting how these products haven't been around for that long, and almost haven't been completely tested.
Yeah, well, I mean, so 2011 was a good example. That was longer period of backwardation actually than 2008. So as far as the VIX futures were concerned, 2011 was worse than 2008. That's debatable, obviously, but yeah, the real test, I think the biggest test so far that the actual ETFs, the actual products have seen, maybe was something like August of 2015, when August 24th, that morning, opened up limit down, after the Chinese devaluation, and then the VIX index itself wasn't even calculating for a little while. The VIX futures were still trading, and then once the VIX finally opened, I think it gapped up to like 52 or something from the 20s or something the Friday before. So that was a wild one. The futures actually, I would say they passed the test. They acted like how you might expect them to. There wasn't too much. I didn't see any sign of like a broken market or anything, other than obviously the VIX index, because you had that to kind of stem from S&P options. The bid asks in those things were just sort of non-existent for a little while that morning as people were trying to figure out what's going on. Yeah, I think the notes, I mean the ETFs in general, they're good products. They just you have to understand kind of what they're offering, and they're going to be tested again at some point, and it'll probably be tested to some degree that we can't even imagine at this point. But I think they're great trading products.
So what would happen if we had an event like you were talking about, an accelerated acceleration event? Would they close their doors at that point, or how would it work?
Yeah, I mean it's hard to exactly say because we've never seen it, but I think it would. I'm sorry. Got our air compressor thing that's super loud here. We'll just wait a second.
No worries. There's some tanks rolling through.
I don't know. That thing is like we work in this old building, so it's like this old school heater or something.
Now, are you at like 160 South LaSalle? Is that where you are?
I'm sorry.
You're at 160 South LaSalle. Is that where you are?
No, actually, sitting in Kaizen advisory office. It's in Wheaton,
In
Illinois.
Wheaton. Okay, in Wheaton. Okay.
So we also work with a futures firm in Chicago. That's Typhon Capital. That's on LaSalle there.
Gotcha.
So we were talking about the acceleration event day. It's tough to say exactly what that would look like, but I think there would be some method of communicating from the issuers of the short ETF, so Credit Suisse, and likely ProShares, who issues the SVIX ETF. They would probably make some kind of announcement that the notes have been redeemed. You would see prices just probably frozen in those ETFs where they closed the day before. And then probably maybe for days you would see that. And then at some point what they do is they work on the final accelerated indicative value. And so there's at some point they say, okay, the ETF was worth, $130 the day before. Today it's worth, $5 or whatever it is after they get their everything closed down. And then you would just get that as the holder of that, you would just get that cash in your account. And probably what would happen then pretty soon is they would come out and issue another series of them because they've been such a good product. And in that scenario, you're talking about VIX would be at some really high level where I think a lot of people would be looking to maybe short it again. So, my guess is we'll probably see it someday. Who knows? But I guess we'll find out.
Let me ask you about VXX. Now, that's supposed to end, I think, in 2019.
Right.
What will happen then? Will they release a new product with a similar name or something like that?
Yeah, so it's just a bond really issued by Barclays, and so this particular bond has a maturity date of 2019, and based on the success of that product, I can almost guarantee they're going to issue another series that has a different maturity date, and there'll probably be some time where they overlap to let people move from one to the other, and then I think on the maturity date, the original one just ceases trading. So it ought to be, in theory, it's a pretty seamless transition, and the new one will act just the same.
So, so let's say I'm a trader and I've got cash on the side, and there's a acceleration event, and XIV closes. What would be the best way for me to capitalize on that accelerated volatility at that particular moment? Would I try to look to something like VMIN if that one was still in playing, or some other issue that was like at a really cheap price?
Well, yeah. So I think if XIV is down, I think, or is accelerated, I think pretty likely that VMIN would be closing its doors too. It's the issuer needs to protect themselves in that scenario because in the reason they don't have it down 100 as the acceleration clause is that if it's down 100, it could easily be down 110, and if it's down 110, now you're starting to eat into the issuer's balance sheet and so no one wants to get close to that. And so I think same thing for VMIN. The issuer for VMIN would probably say, and I don't know, I'm not super familiar with the prospectus for that one, but they would probably, if it's allowed in the prospectus, they would shut that one down as well. So I think on that day, it's going to be pretty tough to try to go out and find a short vol trade. I guess I would assume that VIX options would still be trading. You could look into that market, and the long ETFs would still be probably still be trading as well. So you could look at VXX options as well. Obviously, the bid asks and everything are going to be wild. It's going to be expensive to trade on that day. And if you held some XIV that is now worth zero, I'm not sure your appetite for jumping back into the market, but
yeah. Once you finish getting sick to your stomach, I guess. Yeah, no doubt.
Depends how big your position was.
When I was researching for this interview, I was checking out Kaizen, and I really became fascinated with your company and some of your products there. I wanted to ask you about your background a little bit and your brother's background.
Sure.
And Mr. Young. When it says in your little bio here that you had a role in a startup derivatives exchange, what's that about?
So this was in 2007. My brother and I, I work with my brother. We've worked together for the better part of 15 years.
Oh, wow.
He had invested many years before '07 in a small startup that was looking to do this particular exchange listed their own new products called Clippers, and they looked like a call spread, but packaged up as a future single contract. And they had it on a bunch of different indexes and single names. And then they actually had their own exchange matching engine, really, that was a lot like the ICE exchange. And so they could take these custom derivatives and list them on this exchange and have and sort of be the market maker. And that was the plan there. And then so Mike and I came on in '07 to help them sort of just devise. They had the contract specs down, and so we took those specs and helped them come up with different strategies, that different demonstrations, ways to use these things. And then we went around to prop shops and hedge funds in town and talked to in Chicago, and talked to them about replacing some of your futures or option strategies with these new instruments. And so that grew okay for a little while, and then '08 kind of put the kibosh on that one. But by then we had moved to a family office in Barrington, Illinois.
Oh, that's interesting. Yeah, my background is I was a SIBO market maker for many years. So when I was actually at the tail end of my career doing that, the VIX was just a number. I mean, I left there in 2004, and it was just sort of an indicator. And so
Right.
it's really grown incredibly since then. I know you mentioned to me in your email about Alpha Seeker. Can you explain a little bit about that to me?
Yeah. So again, my brother and I working together for 15 years. What we worked on, especially when we got to that family office, it was in January of 2008, and then obviously that was interesting timing to start getting into managing portfolios just the way we wanted to manage them, and that got us extremely focused after about fall '08. It got us extremely focused on VIX and how all the instruments sort of work together. And then these ETFs came out in '09. VXX came out, and we started using them in our portfolios. And then as we got more familiar with the packaging of these ETFs, we said there's a whole nother trade in here besides using them to hedge equities, and we sort of came up with this. Alpha Seeker is what we call it at Kaizen. It's just trades VIX ETFs, and it trades them. We're either usually directional, so usually we're just short VIX or we're long VIX, and we trade based on a dashboard that my brother and I built sort of from that '07, '08 time frame to just sort of quantify for us what's the risk and reward in these ETFs, which one's the best one to own today, and how much to own it. So we've been running that live since October 2011, and we're offering it at Kaizen for clients here for the first time. So really just for in the last year, we sort of started to commercialize it.
Okay, yeah, because I was noticing when I looked at your website, it listed 3 products, but that wasn't one of them. So if somebody wanted to get involved with you folks in that product, just contact you about it. Could like a
Yeah.
normal person invest? I mean, I guess to quantify that, I would say, is there some sort of minimum investment to invest in that sort of thing?
So no, the minimums are real low with Alpha Seeker because we do it as managed accounts at TD Ameritrade, and we can take non-qualified investors. So we can do as low as $10,000. It's the bigger they charge a flat commission. So 50,000 and up is really the more practical level in terms of investment that makes it cost effective. But yeah, if anyone, if you want more information, you can email me at Matt at Kaizen, Kaizen, Findist, Findist.
Okay, I'll put that up on the screen.
That's how you get to me.
Okay.
Yeah, and so yeah, the website that you looked at was Kaizen is about $250 million total, and we run the bulk of our assets are in 3 mutual funds, 2 of which that I help run, in addition to Alpha Seeker. So Alpha Seeker is we've got our mutual fund business, and then we've got our managed accounts business, and that's mostly made up with Alpha Seeker.
So what's it like working with your brother all the time? I don't know if I could work with my sister all the time.
Right. Well, yeah, we beat up on each other enough when we were younger, I guess, and so now it's fine. It's nice to work with someone that you implicitly trust, and so we've sort of partnered up for a long time, and yeah, it's been great.
That's awesome.
We have a younger brother that we pick on still.
Oh, there you go. um, so, what's your view moving forward this year as far as volatility goes? Do you think we'll have a big spike this year?
Well, you know, when volatility gets this low, it tends to persist down here. That said, we've been 10 and under for quite a while. I would have a hard time seeing that happening. Just a 2017 repeat again. Mostly what I'm looking at in terms of longer term stuff would be interest rates. If the Fed keeps going, which they claim they're going to, and the 10-year today is spiking up a 1-year high here, 261 this morning. That in a heavily levered system, interest rates are key, and so I think if the pace of the interest rate rise in terms of the 10-year yield gets substantial, which it might this year, it could. That would definitely. I have a hard time imagining volatility in the tens with the 10-year, 3+. So that's kind of when looking at longer term. It really all is a rates play at this point, in my view.
I've heard a lot of people say the same thing, that
Uh-huh.
a higher interest rate environment will lead to higher volatility. That's a lot of people seem to feel that way right now. So just to circle back for a second, so if somebody were to want to do your volatility type thing, you were saying that it's managed like TDA accounts, so that you would sort of manage a separate TDA account
Right.
and trade different ETFs in it for them.
Yeah, so it's a nice format. It would be our clients have accounts in their own name at TD Ameritrade, and then we just have power of authority to trade in that account and assess fees.
Oh,
And so
that's
it's nice
interesting.
because the client sees positions. It's all in their own name. They get reporting from TD. All the tax stuff's handled by TD. It's not a hedge fund. And so yeah, in that account you're going to see VIX ETFs only. Sometimes you'll see VXX, sometimes you'll see XIV, so on and so forth.
Do you play with options at all?
In Alpha Seeker, we don't specifically. Our idea there, part of our pitch there is that we like to keep the leverage out of it completely. We actually we run quite a bit of cash in the portfolio, and we're trying to just keep it as simple as you can go in terms of the packaging. That said, we've got other accounts that we trade that we do use the options in quite a bit. It's just a bit more. Obviously, it's a different type of approach.
Well, that's interesting to know. I wanted to ask you just for a second about the market grader fund. Um, and it seems to have a volatility aspect to it as well.
Yeah, so market grader it's called the market grader 100 enhanced index. We are part of the design team of that index, and so it's really two components. One is it's a 100 stock portfolio, and the stock selection is done by a firm down in Florida called Market Grader, and they basically just take company balance sheets, corporate balance sheets, and 10Qs and Ks and all that, and they synthesize it all up in a fancy computer system in great companies, and the top 100 names go into the Market Grader 100, equally weighted. And so those names are always on in this portfolio. And then over the top of that is where we come in. When our dashboard is signaling that it's time to own volatility, that volatility is rising, we'll come in and hedge over the top of those 100 names. And in that fund, we use VIX futures to do that. And so yeah, we've been running that since January 16 with live money. The index history goes all the way back to 2004. And so the index there is KZT MGO. And so that the idea there is just the hedge is not, a penny one hedge where it's going to hedge against a down 1% move in the indexes. It's looking to really take out the big systemic events like an '08 or 2011 and keep compounding on track as much as possible.
I think it's fascinating how the VIX futures are getting integrated into a lot of strategies these days, um, and that one it definitely is.
Absolutely, yeah. And we can actually use that same methodology. So we've broken out the hedging index as its own component. So this is only the long vol kind of signals from our dashboard. and that index is KZTVOL, and that one can really be put over any kind of risk assets that kind of act like equities or have any kind of correlation with equities. So it goes really nicely over the S&P, obviously, and then even junk bonds and more equity-like pieces of the cap structure.
Well, I know people are looking for alternatives to just owning the SPY these days, or just owning the Nasdaq, and the hedge funds have gotten a really bad name lately as not being able to keep up with the benchmarks.
Yeah.
And I guess that's been true for a while, but it's just been publicized more lately, it seems like.
Yeah, I mean it's tough to keep up with a benchmark that's running at a 4 or 5 Sharpe ratio. It's tough to beat that one, especially when you go buy it for 9 basis points with spiders and.
Well, it's very hard. It's very hard for people because the market's just been going straight up, and any alternatives can't keep up with it, obviously.
Yeah.
But that will change. That will change at some point.
Yeah, and really that's what we're trying to capture. That feeling, we're trying to capture that with Alpha Seeker. Really, that in a year like last year, we did great, beat the S&P when nothing happened, and that was obviously mainly we're on the short ball side there. But we think our best year is probably going to be in the next big crisis, when volatility trends higher. And so you can kind of, when we talk to advisors, it's sort of, you can have your cake and eat it too a little bit if you use a little bit of our of Alpha Seeker inside your portfolios. You can kind of keep up. If this wants to go for another 3 years, we should keep up. And if it does turn substantially, and when we eventually do go into a bear market, we ought to help you there too.
What do you think of the articles that have come out recently saying that that the short vol trade is an overcrowded trade, and it's winding up for a big catastrophe for anybody who's shorting volatility?
I know it's definitely there's a lively debate on Twitter, as you've probably seen, about what's crowded and what's popular in terms of that short vol trade. And right now the short vol, or even all of the VIX ETFs put together, is about a third of the open interest in VIX futures. And then the short ones are roughly equal with the long ones in terms of the exposure in the VIX futures market. So, I mean, it doesn't seem like it's heavily tilted towards the short side in that respect. There's definitely, I think it's more to do with the VIX level. So when VIX is this low, a sharp move is much more possible. And when there's more participation in the space and more people have to change positions, or more people are caught offside, kind of getting back to that Brexit analogy, I think there's higher potential for sharper moves. It's debatable whether that's going to, sort of be a self-fulfilling prophecy and cause one of these termination events on its own. It's tough to say. I think any trade that has done 128% annually over the last 5 years is going to get attention, and that's XIV. I am skeptical that it is a crowded trade that's due to kind of collapse under its own weight.
Let me ask you about the term structure for a second. There's been a lot written and talked about with the futures term structure, and how they start out 6 or 8 months out with the futures so much higher than the spot price, and it slowly converges with the spot price. Do you think that that width between the futures and the spot, do you think that that's going to narrow over time if this just continues to be edge in shorting volatility? Because it seems like it's always mispriced now. I mean, I know that that's because there's risk over time, but do you think, I mean, at some point, do you think that will change?
Well, so we actually took a look at, we get this question a bit, and we took a look at the term structure in the first couple months. Those are by far the most open interest is in the first 2 months. We took a look at the average term structure pre and post the VIX ETF era, so pre and post 2009, and it might not be apples to apples in terms of the VIX futures market was a lot different in 06 than it was in 2010, but what we found was that the the average Contango, the term structure actually, instead of getting flatter, it actually got steeper upon the introduction of this VIX ETFs, and has actually slightly steepened as there's been more and more AUM into the space. And I think what's happening is that it's just there are billions of dollars that are tracking that index, and they need to roll futures every day. They need to, most days they're selling the first future and they're buying the second future, and so they're almost creating a bit more of that contango pressure. So I think it's partially, maybe mostly due to the fact that there's just different users in the space.
Yeah, I tend to agree with you on that one. That the guys who are trading futures, they have to sort of make their money too, and they're anticipating this big roll, and it's become obviously a huge part of the volume is this roll that happens, and obviously it doesn't happen every day at a certain time, or people like make the roll happen in different ways, but in the end, it all is going to affect the relationship between the two futures, at least the two front futures that are being rolled, and
Yeah.
it's hard to say. Like, obviously, there's a lot more money in the SPX, not notionally, than there is in VIX futures. But sometimes it seems it's hard to tell if like the cart is moving the horse a little bit here with the people investing in XIV or in VIX products actually affecting the term structure as opposed to just people trading SPX puts affecting the term structure.
Yeah, yeah. I think, I mean, on some of the bigger days, the bigger VIX spikes, when towards that window, towards the end of the day, when the ETFs start to come in there, I've seen on a few days moves kind of in excess of what what was happening previous to the day. So you could see the pace pick up a little bit when on the day when I was thinking back to like August, middle of August last year, the middle of May last year, there was a couple big quick moves, and you saw the front month VIX future go up. After it's already up 20% or 15% on the day, it goes up a quick 5% in 10 minutes right near the close. And to me, it's either literally the indexers coming in there and trying to rebalance, or it's people anticipating that. So you maybe see little inklings of that.
Yeah, I've also noticed, like in the afternoon, sometimes when stuff's been moving around during the day, you see them sort of bring it, quote unquote, back into line. And by that, I mean maybe the M2 future will go up a little bit and the M1 go down, and they'll bring kind of this term structure, the shape of it back to what it was previous
Yeah,
to the move the day before
right.
or whatever.
I would
Um,
say
Go ahead.
one thing I noticed. I was just going to mention one thing I noticed. I sent a tweet the other day of the day of the VIX low in '07, which is sometime in January of '07. The VIX printed like 9 something then, and so I took a snapshot of that day, and the term structure that day was like out the first 5 months was much steeper than it was just the other day when VIX was in the nines. Roughly 10 years later or 11 years later.
Oh,
So what you saw was the VIX, spot VIX in the same place, but the next 5 futures is quite a bit lower. So maybe that lends credence to some of that. Something's different now. Volatility, there's been more buy-in from the futures all the way out, quite a bit. And obviously the spot VIX has gotten much lower than it ever did in '07 as well. I'm
uh,
not sure what's causing that, but
you know how we were talking about how like a 200% move in one of these would equate to an 80% move in the future. Is that a fixed amount, or would that be different if we were in a higher volatility setting?
yeah. So I've looked at it all over the place. Roughly, it's not a fixed amount. First of all, it changes. It's the strongest relationship I've found in terms of the reactivity of a future to the VIX index move is just how many days it has left to expiration. So a VIX future with 1 day left is going to act just like the VIX. It's going to be almost a 1-for-1. With 100 days left, it's going to be much smaller than that. And so the 30-day future, which is what XIV and VXX track, that comes in. There's a range around it, but it's roughly a 50 delta, so about half of the VIX move. And then what I found is that the bigger the 1 day VIX move, the more the delta tends to slip a little on the lower side. And so actually in a move where the VIX is up 30%, you might see the delta is more like 40. or 45. And so, when I come up with my 200% is enough for 80%, that's kind of incorporating, all right, now you're talking about a wild move, one of the biggest ever. You're going to expect delta to slip from 50 to something more like 35 or 40. And that's kind of how I back into that.
Yeah, it has confused me several times why the futures guys have moved in a certain way. When I looked at everything else that was happening in the market that day, be it the spot and everything else, it's confused me a little bit that they haven't moved it higher or lower or whatnot. And I'm always trying to
Yeah.
figure out what I know. I know that there's several forces that those guys are using to price the futures, but sometimes it sort of boggles my mind. Maybe if I had more information on the order flow of all the options and stuff, it wouldn't be so confusing to me.
Yeah. VIX futures are a weird animal because there's no deliverable index, there's no cash and carry arbitrage, there's nothing to link them all together necessarily. So they can, in theory, they can move in opposite directions on all the different contracts, based on views on those certain time frames. So it's definitely different for futures guys, and then it's not quite there for options guys. So it's this hybrid.
Yeah, I noticed that that's a unique characteristic about the VIX futures is that you can't really do calendar spreads. You need to just sort of hedge them against their own options against their own month future, because doing calendar spreads is so difficult to predict what's going to happen with them, that they can move in a crazy way.
Yep. And then you've got the vol decay in the futures, and then you've got the theta and the options, and there's a lot of stuff there's so many moving parts in there.
Yeah, it was interesting. I had a guy on a couple days ago, and he was describing the VIX pit at the SIBO, and a lot of these market makers trade the whole book of products together at the same time, and that must be really interesting
Oh
to do
yeah,
that.
yeah, absolutely. I like to keep it simple, as you probably could tell. I like to keep it simple. I'm gonna trade an ETF. I'm the old-fashioned guy, I guess.
What I just have to ask you about the cryptos. What's your feeling on cryptocurrencies? Do you think
Oh boy.
where are they going to go? What do you think about them?
Um, it's interesting to me. I don't own any personally. I'm still trying to totally understand the technology, but from what I can gather, I like the idea. Blockchain as a technology is interesting to me. That I could see a lot of useful applications for it, which might not include currencies. But I kind of look at right now the crypto space, and as we're recording this, the last couple of days have been horrible for cryptos, but I kind of look at this phase, maybe last year and some of this year, as sort of like the .com, the first .com bubble, where people just threw money at anything that had the word blockchain in it because it's this new technology that's going to change the world. They were sort of right, sort of wrong. A lot of those names went to zero, but then Amazon eventually came out of that, and look at Amazon today. And so I think eventually, after a period when everyone gives up on it, maybe the next phase is going to see some interesting applications for it. Some of the stuff I've seen, be like smart contracts, where you can or smart title transfer. So you're buying a house, you can X out the middleman there and have it recorded on a distributed ledger. That's interesting to me. I'm not quite sure about the cryptos. I think if they got big enough as a currency, I think that you're going to attract government attention, and they're going to probably try to slow that down.
Yeah, it's confusing to me, like separating the technology from the actual valuation of Bitcoin going higher. I've been seen it described as like, well, it's like writing a check versus using a credit card. The value of the check is not that great. It's a different technology, but it's not like a check with no money on it is worth nothing. So it's
Right. Yeah, and I would say, I've seen that argument out there, and I would say that's probably accurate, but the system for clearing checks is pretty valuable. And so I sort of, it is, you need to sort of separate the two. And I'm by no means an expert here, but that's what's interesting to me. I'd like to see where the blockchain technology goes. One of the worst uses for it I saw potentially today was they're looking at using blockchain to create MBS, new MBS, and sort of keep track of all these mortgages and package them and securitize them and sell them on. That's not that's
Sounds scary to me.
Yeah, right. We need that like a hole in the head, I think. But
Yeah, that definitely sounds scary to me. All right, well, listen, I really appreciate you coming on, and I love what you come up with on Twitter. It's always interesting and always amusing and spot on.
thanks.
And I look forward to possibly talking to you again in the future.
All right. Yeah. Thanks for having me. Appreciate it.
Yeah, that was awesome. Here, let me turn this off for a second.